It can feel scary to invest when the stock market is at all-time highs, but that is not a reason to delay. Over the last 10 years, the S&P 500 hit a new all-time high on 13% of trading days, or about 1 in every 8 days. All-time highs are not rare and something to be scared of. They are normal and required in a growing economy. But the thing that really surprised me while making this video is that investing at an all-time high has historically produced better returns than investing after the stock market went down by at least 10%. In today's video, I'm going to talk about how to invest when the stock market is near all-time highs and how you can make the best decision with your money. Feeling nervous about investing at all-time highs is very normal, and I do this a lot. You see a stock with a crazy parabolic growth curve, and it feels like the stock has already gone up as much as it can. Similarly, when you see a stock that's gone down recently, you feel like it's at a discounted price and that there is an opportunity to have a bit higher of a return. If you really think about why you're scared to invest when the stock market is at an all-time high, it really shows why it doesn't make sense, and this is just a pattern or a habit of the human brain. Because in order for the stock market to go up, which is the reason we are investing, the stock or the market that we are buying has to appreciate in value, which means it needs to be hitting all-time highs. If there was a stock market that never reached all-time highs, no one would ever invest in it because it would not be appreciating value, which is the reason we invest. Now I want to go back and give a bit more context to the claim I made at the beginning of the video, where I said that buying into the stock market at an all-time high actually outperforms buying into the stock market once the stock market has already dropped by at least 10%. And so for the US stock market, purchasing at an all-time high, the average historical returns were approximately 13.7% over the following year, 10.6% over the following 3 years, and 10.3% over the following 5 years. And now if you had invested when the stock market was down by at least 10% already, the average returns after that were 11.7% over the following year, 10.3% annually over the next 3 years, and 9.6% annually over the next 5 years. So while the difference isn't that big, it just shows that the perceived discount is not actually a discount, and that you are actually better off buying at the all-time high than buying when it was down and you thought you were buying it for cheaper than it actually was. And this kind of goes back to the fact that the market will almost always be priced correctly. There's almost never any mispricing that you can take advantage of as a retail investor. And so to worry about those things makes no sense. This is also an example of people thinking on a short-term horizon. In the short term, markets are very unpredictable. However, we know that in the long term, stuff tends to trend towards the average, which is what we want in investing because we would like to have some certainty. So thinking on a long-term horizon is always way more consistent than on the short term. Now, the biggest problem with waiting for all-time highs is you're actually missing out in time in the market. A lot of people will set aside cash or wait for the stock market to crash. But while you are waiting, the stock market may still go up in value, and on average, we know the stock market will go up. Let's say the stock market does crash. In the time that you were waiting with your money not invested, the stock market could have gained another 30-50%. And so by the time the 20% stock market crash happens and you purchase the stock, it's actually still at a higher price than it was when you were first deciding to wait for a stock market crash. And that's where we get back to the advice that I'm sure everybody has heard, is that time in the market is better than timing the market. And now that brings us into the debate of lump sum investing versus dollar cost averaging. Lump sum investing is just putting all the money you have available to invest in at once, whereas dollar cost averaging is splitting up that amount and investing it over a time horizon or a time period. So an example would be if I have $10,000 that I want to put into the stock market, if I was lump sum investing, I'd be putting all $10,000 in right now. But if I was going to dollar cost average, that would maybe be putting in $1,000 every month for 10 months. And the difference here is that in dollar cost averaging, you are sort of hedging against fluctuations in the stock market. So if the stock market went down, you would have been able to bring your average cost down and get into the market for cheaper. But similarly, if the stock market went up over that time period, your average cost will be higher because you're also buying some stock when the stock market has already gone up. Generally, people dollar cost average because it reduces your risk from short-term fluctuations. But historically, it has been proven that lump sum investing leads to higher returns. And the reason for that is the exact same as why you shouldn't wait while the stock market is at all-time highs, because on average, the stock market goes up. And so any time you have in the stock market is valuable. And so the logic is you want to have as much money as you can in as early as you can to generate the biggest returns. Again, dollar cost averaging is focusing on variability in the short term, and we know that the short term is unpredictable, so there is no reason to obsess over it. And by delaying some of your purchases, you are missing out on the potential gains of the stock market. And again, while dollar cost averaging can lead to higher returns if the stock market goes down over your investing horizon, we know that on average, the stock market goes up, and therefore it is more likely that the stock market goes up during your investing horizon and therefore increases your average cost. And again, just because lump sum investing is slightly more efficient than dollar cost averaging, that doesn't mean you have to do lump sum investing. Emotions are a very big part of investing, and if you feel that you will be able to be more consistent and less emotional if you use the dollar cost average method of investing, you can still do that. If you're in a situation where you want to reduce risk, dollar cost averaging is actually the better option, because again, you're essentially lowering the short-term fluctuations, because you are essentially making it much more likely that the current price of the stock is close to the average cost you have. And the main takeaway from all this information is that if you are young or if you have a long-term horizon that you are investing for, it's to not try and wait and time the market. It's not to dollar cost average. It's to actually put as much money as you can as soon as possible into the stock market, no matter what the price may be. Over that long-term horizon, any short-term fluctuations in the price will not matter, and this ensures that you have more time in the market to generate returns. In conclusion, the market being at an all-time high is not a reason to abandon your investment plan. An all-time high is just another day in the market and is a good sign that your money is growing. If you're currently invested in the stock market, comment down below what you're investing in right now, whether that be individual stocks or ETFs. And if you enjoyed this video, please leave a like and subscribe, and let me know what other video topics you'd like to see on this channel. I hope you guys have a great day, and I'll see you guys in the next video.